Thank you very much. We are very happy with the way that the investment trust has performed both year to date and since inception. But I think that the message we want to get across to you today is that journey is far from over, because we still see very significant value in the UK equity market. And anecdotally, we are beginning to see more interest, I think, coming back into UK equities. So with that, let's dive into the presentation. I want to start here. Neil mentioned that we had sort of compared the conditions today to 2000, and that's what we're trying to display in this chart. So this chart looks at the spread in valuations between the cheapest part of the market and the most expensive part, or in this case, what is deemed value and growth. It's a 50-year chart, and I suppose I would just ask you to look at where that spread got to in 2000. So as that line's going down, that's value stocks getting cheaper relative to growth stocks. Look where we got to in 2000, and just look where we are today. So the dispersion between the cheapest and the most expensive parts of the market are wider today than they were back in 2000. And I suspect many of you on the call today will remember what happened post 2000. That was a fabulous period for value investors. Turning to, I suppose, geographies, we're still very conscious of the fact that a lot of people are still extremely smitten by the US equity market. I think if we look at the fact that it now represents over 70% of MSCI World, that probably tells us that it's a pretty popular market. What we're trying to do in this chart is basically just remind people that you need to look forward, not backwards. And the way we're doing this is we have 100 years of data of the US equity market here. Across the x-axis is valuation, and we're using a sort of market cap to GDP type of valuation. And up the y-axis is the subsequent annualized returns that you earned when you bought the market on those different valuations. So I always think it's easy to see if I give you some examples. So if I ask you to just look at 0.5 at the bottom, so that would be one of the cheaper valuations, run up to where you can see the blue dots and the black line. That means when you paid about 0.5 times, you earned returns of between 16 and 18% per annum for the next 12 years. Look at 1, which is the sort of average valuation. When you paid an average valuation, funnily enough, you've got average returns, so between 8 and 10%. And if you go to the far right-hand side of this chart, you can see where we are today. In fact, the arrow is where we were at the end of the year. Where we are today is actually sort of right down at the bottom. So if this data holds, buying the US equity market today, you are buying it on one of the highest valuations that's ever existed. And you should expect to lose between 4 and 6% per annum. So just making the point here that whilst we all know in the short term there isn't a correlation between valuation and subsequent returns, the markets that are expensive can carry on going up. In the long run, there is still a very, very close correlation, and where the US equity market is valued today would suggest that you're not going to get good returns. Now, just contrast that with the UK equity market, which is obviously the area that the Temple Bar portfolio is focused on. So chart on the left here is again a 50-year chart. It's the valuation of the UK market relative to MSCI World. And we can see we're basically at the low point of 50 years, pretty much the cheapest that we've been for 50 years. The dark line across that is the 50-year average. So, because of the different sector composition of the UK, we have a higher weight in financials and energy and materials. The UK is always traded at a discount, but about a 17% discount. Today, we're at a 45% discount. So on a historic basis, the UK looks very, very cheap. And on the right-hand side, we've just looked at the valuation of different sectors versus their US equivalents. And the reason for doing that is that people will often look at the chart on the left and say, because of Brexit or whatever, the UK should be cheap. But we always ask them to sort of look at global sectors. So if you look at something like the energy sector, you'll find energy stocks, which have very, very similar exposure to UK energy stocks, have very similar exposure to US energy stocks, and yet they trade on half the valuation. So BP and Shell trade on about sort of 6 times earnings. Exxon and Chevron about 12 times earnings, despite the fact that they have no real exposure to the UK economy. So there is a real anomaly there. I know UK equity managers have been banging on about how cheap the UK equity market is for a number of years, and people will rightly always come back and say, well, that's great, but what's going to be the catalyst? And this year we have been talking about two notable catalysts coming through to realise that value, and I think what's pleasing is that actually they have started to materialise very significantly, and they have driven a lot of the value that we've seen year to date. The first of those is corporate takeovers. The chart that we're looking at here is the number of takeovers of UK companies per year. If you look at the last decade, we've averaged about 40. Last year that jumped up to 64, and this year the sort of run rate is higher again. In the first 4 months of the year, the trust had four companies in the trust had received takeover offers. So those were Anglo American, Currys, Direct Line, and IDS. Obviously, 3 of those bids have gone away. IDS is still outstanding, but I think the key point here is that tells you that the corporate world has actually recognised the incredible valuation that there is available in the UK market, and they've started to they've started to benefit from it. Outside of companies in the trust, there have been other very significant bids year to date, haven't there, in companies like Darktrace, Hargreaves Lansdown, etc., etc. So value being realised in corporate takeovers. The second area that we have been talking about all year and has really started to come through is share buybacks, and I'm actually going to hand over to Nick now to talk about how share buybacks in the UK have again begun to realise value.
Great, thanks, Ian. So yes, the level and number of share buybacks has picked up pretty significantly, and according to this chart is sitting at between 40 and 50% by number of stocks in the UK at the present time. We, as you would expect, as Temple Bar portfolio managers, invest within the UK market in the subset of the most lowly valued companies, and therefore you would expect the level or the number of buybacks within the companies in which the trust is invested to be higher than this, and indeed that is the case. So if you take, for example, the top 10 largest portfolio holdings within the trust, 8 out of those 10 companies are undertaking share buybacks at the current time. And it's important to reflect a little bit on share buybacks, because they are enormously important and do have the ability to drive enormous value for shareholders over time. If you just consider the simple arithmetic, if you have a company which is on a cash PE of 10, turn it round, call it a free cash flow yield of 10. If that company uses half of that free cash flow, so 5% of the market cap, to buy back undervalued stock, then of course arithmetically that drives 5% earnings per share growth in the following year. So the shareholder that year will have received perhaps a 5% dividend and 5% earnings growth, because the number of shares in issue has declined. So very, very powerful. And of course, the lower the valuation, the more powerful the value driver for the remaining shareholders who choose not to participate in the share buyback. You can add effectively the dividend yield, and you'll be aware that the UK market is one of the highest yielding markets in the world. You can add that to what's called the buyback yield, the amount of market stock that is basically being retired in a particular year, to give you a total shareholder return, if that's the way you want to think about it. And in the UK, if you have those two together at the current time, that's knocking in at around 6%. That's a pretty attractive number. you might think to yourself that the long run equity return that you're looking for is around 8% per annum. Obviously, we would hope to do a bit better than that, but you might be looking for 8% per annum, and it's worth reflecting on the fact that you're getting 3/4 of that pretty much up front, simply by virtue of the fact that the companies are generating cash and repatriating that cash for shareholders. And I think what's often we think what is often missed, sorry, is how powerful these drivers of value can be over the long term. And we do think in stock markets generally there is a misconception, and the misconception is that you need oodles of revenue growth in order to enjoy spectacular capital returns, or spectacular total returns over the long term. And we want to absolutely disabuse you of that notion by using two examples really. One is Next PLC, the other I'll come on to is tobacco company BAT. Take a look at Next. I mean, Next is a great example. It's a relatively mature business. It's a well-run business, obviously. It's got some growth. Sales growth over the last 20 or so years has been between 5 and 6%, a little more than nominal GDP, but you certainly wouldn't call it a growth company. But the company has been well managed operationally, and as a result of that, margins have expanded somewhat, so operating profit has expanded by more than the sales. But the real kicker has come from the earnings per share growth. So they managed to turn 7% or so operating profit per annum growth into over 12% earnings per share growth. And how have they done that? They've done that simply by retiring or reducing the number of shares in issue over time. And I believe I'm roughly right in saying that over that 20-year period, the number of shares in issue at Next has declined by around 60%. So that's enormously powerful. And you add that earnings per share growth of 12% to your dividend of about 3% per annum to get an overall return of about 15% per annum. And of course, given the magic of compounding, I believe I'm right in saying that over 23 years or so, 15% per annum total return turns £100 into around £1,700. So enormously powerful. And that's the way that we like to think about the companies in which the trust has invested. This is what we are looking for. We're not looking for companies that are going to set the world alight. We're going to look for companies that have reasonable franchises, reasonable market positions in their industries, can grow their profits over the long term, not each and every year, but where they're being sensibly run, they're generating cash, and that cash is being repatriated, it's being used to do sensible things, it's being repatriated to shareholders. And you would be amazed at the sorts of returns that can be on offer. And I won't dwell on the example of BAT, but in some ways it's even more incredible because BAT, you can see on the right there of the bar chart on the left, you can see that knocked in an annual total return of over 20% per annum. And yet the company's sales or revenues grew by about 1 to 2% per annum, because we all instinctively know that obviously tobacco volumes have been declining gradually over time. But again, it reinforces this notion that companies that run well operationally, generate cash, and use that cash to retire cheap equity to the massive benefit of the remaining shareholders. It just shows how powerful that can be. So again, we want to bring this idea back to the portfolio today. So we've got 8 stocks here, 8 companies, all well represented in Temple Bar. These 8 stocks probably in aggregate account for over 40% of the Temple Bar portfolio. On the column on the left is the 2-year earnings per share yield. So let me explain that. So that is simply today's share price divided by the earnings per share delivered by the company in 2022 and 2023. So that's a 2-year yield effectively. Second column in from the left is it's the same calculation, this time using the dividend. So BP, for example, has given you a 2-year 9% dividend yield. The third column in, we look at the degree to which the number of shares in issue declined in that 2-year period to give you to calculate the element of return that is derived from share buybacks, and you can add columns 2 and column 3 together to give you a total cash shareholder yield over two years, obviously. And I mean, just look at some of the numbers. If you look at the energy companies knocking in at between, 3 energy companies there, 23, 24 and 29%. The banks coming in at between 20 and 40% in the case of NatWest, or in the case of NatWest, there was a return of capital. So that level or rate of return is actually unsustainable at today's level of profitability. And then insurance companies as well doing the same thing. I mean, we could absolutely add Aviva into this, which is also held by the trust, but actually we use the example of NN, the Dutch insurer, which has given you a 2-year shareholder yield of around 26%. So you bought NN 2 years ago. You've got 1/4, just over 1/4 of your investment back already, just over 2 years later. And then this is obviously the top 10 of the trust. Again, just so as I said earlier, 8 out of this top 10 are in the process of buying back stock. Some of them pretty aggressively. Look also at the dividend yields on the right. So obviously some very attractive dividend yields, and you can add those two numbers together and you can get a flavour for the level of shareholder return which you can be expected to enjoy over the coming years, assuming, of course, that there's no re-rating in the underlying shares. That assumes no re-rating. If you were, by some wonderful stroke of luck, to get a re-rating in the share, if the market were to decide that actually NatWest Bank shouldn't trade on 7 times earnings, it should trade on 10 times earnings, which I hope you'd agree is not an aggressive multiple, then obviously that would give you a further significant uplift in the share price. So we're never going to run a portfolio that's going to set the world alight, as we say. But hopefully you can look at those companies. They're reasonable businesses. Yes, they have their challenges, of course. What company doesn't? But then you can think about the valuations, the level of shareholder return that might be available to you over the coming years, and perhaps compare that to some of the charts that Ian was showing you earlier about some of what looked to be extremely high valuations that seem to be prevailing in other parts of the world. And Neil, I was probably going to leave it there, and I think obviously very happy to take questions.
Perfect. Thank you guys for running through the presentation at this stage. So just to remind everyone, there's a Q&A box at the bottom of the screen. Hopefully you can see. If you do want to ask the guys a question, please populate that now. I'll kick things off, if I may, and just ask if you could let us know if there have been any changes to the trust in recent months that you'd like to articulate.
Yes, so I suppose we'll probably highlight we have recently purchased hold on to your hats, IAG, the airline, which is a combination of British IAG is International Consolidated Airlines Group, which is an amalgamation of British Airways, obviously in the UK, and Iberia in Spain. Airlines are interesting, aren't they? Because obviously it's been as an industry, it's been an investor's graveyard for a long period of time. You know, and I think we probably instinctively understand the reasons for that. I think it's a capital-intensive industry. It's operationally leveraged, so small changes in the level of supply and demand obviously have a very significant effect on profitability. And we would also say that there hasn't been that much discipline in the industry either, to the extent that the industry has, habitually made the mistake of putting on too much capacity during the good times, which of course has only amplified the negative effect of the subsequent downturn. And of course, recently, investors have been horribly scarred by what happened during COVID. And I think, we think we can't prove this, but it feels to us that there's a whole cohort of investors out there who literally won't go near an airline because of the experience during COVID in 2020. So why do we think that they fit the bill? Why do we think that they're actually, as a group, they are quite interesting? Well, we think that yes, they will continue to be cyclical. And of course they will. But as we all probably know, anyone who's been on an airplane will understand recently, given the prices they've had to pay, that actually airline profitability is very good at the moment. So if you take IAG, it's standing on a price earnings ratio of between 4 and 5 times. That's both historic profits and this year's profits. So think about that's an earnings yield of 20 to 25% at current levels of profitability. Now, of course, the obvious question is, oh wait, but hang on, is current level of profitability sustainable? We can't be sure of that, to be honest. Of course we can't, because that does depend on whether the high levels of demand that we've seen in recent months and years remains, and it wouldn't be a surprise to see some dampening in demand. But what we think has changed very much for the better is the supply dynamic, and I think that's a mix. We think that's a mixture of two things. One, that the companies themselves have recognized that there needs to be more discipline in the industry, and now the industry is coalescing around various alliances. There has been a significant degree of consolidation in the industry, both in continental Europe and also in the US. That's point number one. And point number two is that it's just the extreme challenges these companies face with regard to the supply chain. And we're talking about both getting hold of the airplanes themselves, but also the servicing, the engines. Even if you wanted to set up an airline tomorrow and disrupt the industry and add additional supply, you couldn't do it because you couldn't get hold of the airplane. So we think that is a change for the positive that's not going to go away for some time. And we think what that means is that the structural profitability of the industry has stepped up. This, of course, at a time when we think most investors have completely given up on the industry because of the horrible experience they had during COVID. So a combination of those two factors, we think, means that actually it can, we were showing earlier the chart of what we might call cyclical cash compounders, companies that, as I say, can generate lots of cash and give that cash back to shareholders. We would say that IAG could absolutely fit on this page, and it wouldn't be a surprise if we in future webinars actually it does feature.
Great, thank you. Moving on to the next question, a brief one on a particular holding, Next. I believe that you had exited Next. Have you re-entered the position?
No, we haven't. It's a fine company. we just think it's now reasonably fairly valued. Whereas actually, you might remember we own Marks and Spencers in the portfolio, where we think that Marks and Spencers is sort of, a couple of years into a turnaround plan that appears to be coming through very significantly at the moment. So that's our exposure in UK retail.
Yeah. Okay, thank you. And a question on limits, just asking whether you have a market cap limit within the portfolio.
No hard limit. As a rule of thumb, we won't go below £1 billion market capitalization to start off with.
I suppose just to add to that, I think I understand where the question is coming from, because undoubtedly, people see lots of value in sort of small cap UK equities, and we don't dispute that at all. We just think that there's also lots of value in large cap UK equities, which hopefully we've shown you today. And therefore, why do we need to take the extra liquidity risk by sort of going down the market cap spectrum into the small cap area? So, quite happy to be sort of mostly large and mid cap at the moment.
Okay, understood. Thank you. A more general question, but a good one, I think, for observers of Temple Bar to understand. What three things do you think most differentiate Temple Bar from others in the sector, including other value-orientated trusts?
I'll go at that. I think the purity of the investment style. Whenever you see this sort of horrible things, don't you? This sort of that style analysis you can get. Obviously, you can crunch portfolios through, bits of software that analyze the investment style, and values on the left and growth on the right, and we do very much come out as the value play. We recognise that the trust it has a wider role to play within people's portfolios. We're not suggesting for 1 second that people put 100% of their investment in Temple Bar. That would be a crazy thing to do. So we have a role to play. So when we want to provide a pure exposure. So when people want a value exposure, they should come to Temple Bar, because that's basically what we give. So that's point number one. And Ian could do number three. I'll do number two. And number two is, I would say, our experience. You said 50 years experience. I just want to be clear. That's 25 each, by the way. That's not.
We're not 60 years old.
We think the experience counts. Experience counts in financial markets, because history doesn't repeat, but it does rhyme. And only by experiencing full stock market cycles do you get to see the full gamut of human emotions. And I think, given that we are, as value investors, trying to exploit emotional inconsistencies within other investors, it's very important that we ourselves have a decent level of experience in that regard. So that's point number two.
And I'll do point number three, which is actually the firm that we work for. So obviously Temple Bar is a company itself. Nick and I work for a company called Red Wheel. We have worked here since 2010. Red Wheel is a partnership. And I think the reason for mentioning it is that I guess we all know, don't we, that there is an awful lot of consolidation going on in the asset management industry today. And there's also a lot of movement. So fund managers moving around between companies. Because of the unique structure that Red Wheel has got, you're extremely unlikely to have either of those problems thrown your way. So it's extremely unlikely that Red Wheel's either going to buy something else or get taken over by someone. It's pretty unlikely that Nick and I are going to move. So the sort of headaches that I guess that you have at other companies, you're unlikely to get at Red Wheel. Good question, by the way.
Yes, I thought so. Yeah. Moving on to the next good question, which is, given the oft-cited lack of UK technology and growth companies as a reason for why the UK is cheap compared to global peers, in slide 3, so if we can turn back to that, that particular slide, it would be useful. What is classed as UK growth, and what is the chart actually telling us?
It's very simply the MSCI produce two indices. One's called MSCI Value, one's called MSCI Growth, and they will look at various things. So your historic growth rates and return on equity and so on and so forth, and then they basically construct those two indices. They're not perfect. They're not perfect indices. And then what we're actually looking at is, so if you look at the y-axis, it says there, so basically this is constructed by Morgan Stanley, and they look at it's a combination of the price earnings ratio, the price to book, and the dividend yield of those two indices. And effectively, you're looking at the difference between them. So when that line is, as I say, when that line is going down, the spread between if you want to think about it, the cheapest and the most expensive stocks in the market is going up. So, by the way, this is a UK line chart. So you can forget about US technology. US technology is not included in this data at all. This is purely the UK. Effectively, you're just looking at the spread between the cheapest and the most expensive parts of the market. And the message here is that when that line is low, that's a sort of, if you want to, for want of a better phrase, a target-rich environment for us. That means the opportunity set has gone up. So look at some of the times that it's gone down. Early 1980s, so that's after the Nifty 50 crash, 2000. So after when the TMT bubble pops, 2008 financial crisis, 2020 pandemic, and then where we are today.
Great, thank you. Could we move on to UK banks, and looking at the political environment, how concerned are you about the political risk regarding UK banks, given sort of talks of a revised tax structure? Can you talk about that and whether how you feel about the valuation discount relative to international peers when you're answering that question, if possible?
Yeah, no, it's a very fair question. I think with regard to valuation discount, I think it's important to differentiate between European banks and US banks, because actually the trust, it's not on this page, the trust has a holding in ABN AMRO, the Dutch bank, and that's trading at around a similar valuation to NatWest and Barclays, and indeed Standard Chartered, which is also not on this page. Of course, Standard Chartered, let's pretend that there's a windfall tax at it might be, I don't know, but it might be that Standard Chartered wouldn't get caught up in it. But I suppose the point I'm trying to make is that it doesn't feel right now as if the market is particularly penalising UK banks. The division today seems to be the US, as is the case in a number of other sectors. Division today seems to be the US versus the rest of the world. Some sort of windfall tax on the banks, absolutely, it's a risk. And I suppose we have no ability to gauge that risk better than the next person, and so it's not a risk that we could act on. Let's say we had some sort of fit and we decided to go and sell the banks on the back of it. Of course, the person was selling them to is as aware of the risks as we are, so there's no advantage in inverted commas to be gained from that. Obviously, we hope that it'll be very, very interesting to see, won't it? It'll be a test of our new government's growth credentials. They did say before the election that there wouldn't be windfall tax on the bank. Let's see if they're good to their word. By the by, we think it's totally unjustified. Maybe we would say that. I love this idea that interest rates go from 4% to 1%, but they stay for sort of 10 years or so. Then they go from 1% to 4%, and everyone's set back to 4%, and everyone says, oh, look, they're making excess profits. No, they're not. Interest rates have just gone back to where they would, But banks today make a return on equity, typically 10 10%. I mean, so Barclays is making 10% today. That doesn't strike me as profiteering, but you know, anyway, blah blah blah. So we don't we don't know, but we think we think you know, it would be very, very strange if the windfall tax was sufficient to somehow upset the investment case.
Brilliant, thank you. Very thoughtful answer. I'm going to try and wrap up two questions into one here, which I think are basically driving at the same thing. I'm going to take the second question first, actually, because I think it sort of asks it in a relatively straightforward way, which is, you know, can the government convince UK institutions to invest in UK listed companies? And again, the second question sort of asks about the extent of outflows since Brexit and, you know, what the main reasons were behind this. But I think sort of wrapping up the two thoughts together, you know, things are arguably have been at very depressed levels since Brexit, but, you know, to what extent can the new government or will the new government come in and force institutions to buy UK listed companies?
I don't think, it's unlikely that we're going to see anything that's going to force UK institutions to buy UK companies. You know, at the margin, they might come up with a couple of ideas to incentivize people to maybe invest in UK companies, whether it's a British ISA or something like that. The reality actually is that I think for UK equities to continue to do well, you need to create the demand, don't you? Well, sorry, there's two things actually. Number one is a lot of the selling we think has basically come to an end because if you take UK pension funds, you know, in the last 20 years, they've gone from sort of 55% of their exposure to in UK equities to about 2%. So that, you know, that journey is pretty much done. There's not an awful lot of selling really now to come out. Ditto the large UK wealth managers. I think they've spent the last few years selling down UK equities. I think that journey has probably finished. Anecdotally, you know, if you talk to salespeople at Redwheel, some of them will say they've received more expressions of interest in UK equities in the last sort of 6 weeks than they have in the previous 6 years. So anecdotally, it kind of feels like, you know, sentiment is starting to improve, interest is beginning to pick up. And then I think the final thing is, you know, when we have been talking to companies and we've been saying to companies, look, you know, your valuation is very low, you know, buying back your shares makes a lot of sense for shareholders. To a certain extent, you're creating demand, aren't you? So you know, at once, I don't know if this is still the case, but at one stage we know that there was about £1 billion a week of share buybacks going through the market, going through the UK market. So to a certain extent, you're creating your demand. And I think, you know, whether the UK government comes up with anything or not, you know, if they do, that's great. If they don't, then it kind of feels like at the margin, the selling's finished and the buying is starting to sort of turn up a little bit.
And I want to reiterate that you remember it is all won and lost at the margin. You don't need a gush of money. You just need the selling, the marginal buyer or seller to become a buyer, and that will turn it.
Agreed. Thank you. So I've got 2 or 3 stock specific questions, I think, and then 1 or 2 more corporate ones, and then we'll aim to wrap up. First one is on BP, really. While the UK looks cheap compared to global peers, to what extent is the UK priced relative to itself? Is BP today valued the same as it was in 2015? And is the company worth less anyway?
I don't. BP, obviously, BP is the trust holds 3 energy stocks, as you can see there. So Shell, Total, and BP. And of the 3, BP is the one that is struggling operationally. There's no doubt about it. And I think where investor concerns are the greatest. I mean, the question compared BP today to 2015. I mean, we think that the company is much better placed than it. I mean, we don't. It does have its fair share of problems. Don't get us wrong, but we do think the company today is much better placed than it was at that time. You've got to remember, where were we in 2015? We had just come off the back of the traditional boom bust commodity cycle, where 2014 oil prices were over $100. Way too much capital was committed to the industry, and that had gone some way to precipitating the subsequent oil price crash. And of course, that had that resulted in basically sector cash flows diminishing very, very significantly. Do compare that to today, where, yes, of course, cash flows will ultimately always be driven by energy prices, and we see some volatility in the oil markets, and we, of course, can't predict where they're going to go. But nevertheless, the companies are in a very different place. They are as a group, certainly, generating lots of cash today. We showed that on that 2-year return chart, and they're deploying that cash flow sensibly. They're not repairing balance sheets. They're not undertaking risky projects. By and large, they are giving it back to shareholders. So yes, absolutely, we understand the question surrounding BP, and it's basically it is a concern, definitely, within the energy sector, but we think that certainly the sector as a whole, and even BP itself, is much better placed than it was a few years ago.
Great, thank you. And in terms of the situation with Marks and Spencers and Ocado, are discussions over payments nearing an end, do you think? And how does this bode for future relations?
To be honest, we don't have any sort of inside track on that. It's the company as a whole, as we mentioned earlier on, has been doing phenomenally well, both in clothing and home and in food retail. And the one sort of problem area, the one bit that Stuart Machin, the CEO, knows that the question is always going to come up is Ocado, which has not been going so well. Although I think actually is on a sort of improving track at the moment. Now, how ultimately that resolves itself, we to be honest with you, we don't have any special knowledge of that situation.
Fair enough, thank you. And the last stock-specific question I have is on ITV, and whether you could talk through your investment thesis on ITV at this time.
I'll do ITV. Yeah, it's we always say that there are certain companies where people tend to value them off the bit that they sort of know, and I was going to say know and love, but it's often know and hate. And in the case of something like ITV, that would probably be the thing that you turn on every evening when you get home, i.e. the TV business. And what a lot of people don't know about ITV is that they have this very, very good studios business, which is over 50% of its revenues come from overseas. So obviously, it's been a beneficiary of the fact that we've had lots of new broadcasting companies set up over the last few years. Therefore, demand has gone up. So revenues have gone up in the studios business. It makes roughly a sort of 15% margin. We think that if you value that studios business on its own, you probably get to the market cap of ITV today, something like that sort of region. If we take the other part of it, we take the broadcasting bit of it. That is an area which is going through a transition. So obviously, a couple of years ago, it made the announcement that it was going to have to invest to go into streaming, so ITVX. We had a big lunge down in the share price when that announcement was made, because basically people just focused on the investment that was going to have to go into that area, and they gave them no credit at all for the potential return that they might get from it. A few years on, it appears to us that actually ITVX is beginning to perform quite well, and is quite powerful. So actually, we think the business has turned a corner, is starting to improve, and that's not being priced into the shares yet.
Great, thank you. So a more corporate focused question on just going back to your views on buybacks and dividends in the market. Do you have a preference as to whether UK companies buy back shares rather than grow their dividends, or are you indifferent between the two?
It's a difficult balancing act, to be honest. Obviously, the economic theory would tell you that when your shares stand on a price earnings ratio of 7, you should be diverting every pound of excess cash flow to buying back your stock. In theory, you should cancel your dividend altogether, because that's most value enhancing for the remaining shareholders. But of course, we companies need to be pragmatic. We need to operate in the real world. Obviously, many shareholders, many shareholders, particularly shareholders in Temple Bar, place enormous value in that dividend. So it's a question that comes up a lot with companies, especially as the companies in which the trust is invested are lowly valued and they are generating a lot of cash, and they do come to us with the question as to what is the optimal way to deploy that cash. And I think the honest answer is we think it's right to adopt a common sense approach. Pay a generous dividend, absolutely. Grow that dividend steadily over time if you can. Not all industries allow you to do that, and then take the excess above that to retire cheap equities. I'm afraid there's no magic answer to that question.
Yeah, no, fair enough. Let's take this as the final question. Given the view on share buybacks is so positive, have you suggested to the board that they, in the same terms, seek to control the discount on Temple Bar? What's your thoughts on that?
So actually, the board were doing share buybacks earlier in the year when the discount was wider than it was today. As you're well aware, Neil. Actually, we haven't bought back any shares for a number of months now. As I think the performance has started to come through, the discount has narrowed, and there's no real reason at the moment to be buying back shares. So
yeah, no, I've got the numbers to hand actually. So there's been no buybacks in the last month or quarter, but in the last year, about £32 million worth of shares have been repurchased. And if you look at the market announcements, you'll see at what level the board have been going into buy back shares. So there is a process that's in place there. But thank you for the question. I think what I'm going to do there, if I may, is to wrap up and thank you, Ian and Nick, for your presentation today. And thank you all for your interest today. It's very much appreciated. The market dynamics are clearly changing. I think everyone is examining the data. And of course, everyone's waiting for the US jobs data tomorrow, for example. But we've all seen signs of profit taking in frothier parts of the market when volatility goes up. So it's time to consider the UK, time to consider Temple Bar, one of the top performing funds of scale in the UK equity income sector. Arguably a great place to park some cash when looking for UK exposure, especially as you're getting, as you've just heard, circa 6% or so from dividend yield and buyback activity in the market. So TMPL is the ticker for those interested in buying shares, and Cavendish are the company's broker. Please speak to your Cavendish representative for any interest in shares. But if you've got any further queries, or requests for information in regard to Temple Bar, please do not hesitate to contact either myself or one of my colleagues at Frostrow Capital. Thank you all for your time today. Appreciate it.
Thank you. Many thanks.